Good morning, good afternoon, depending where you are, and welcome to our webinar today about understanding the Main Street Lending Program. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. Later in the day, we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I'm an Inc. columnist. I've advised prior administrations and the Treasury departments about the business credit markets, as well as the Federal Reserve. I have a book out on Amazon called The Growth Dilemma, and for my entrepreneur organization friends out there, I'm a proud member of EO Philadelphia. Some disclaimers that my lawyers asked me to read. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. Finally, we encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is a time for all of us to be reimagining our business. Recovering from COVID-19 and all the uncertainty right now is definitely a battle. And in any battle plan, you need a strategy. Is your strategy to pivot 5%, 50%, or 90%? What will your team look like going forward? And what ammunition will you go into this battle with? And in this case, we refer to ammunition as cash. You want to think about cash in both offensive and defensive needs. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario, and where will the cash come from? And what opportunities will you consider as you look into the future? This is the vein I'd like you to think about the Main Street Lending Program that is $600 billion allocated for it. It is in effect until September 30th, 2020, which means to have a shot at it, you really need to have your application in the next 2 to 3 weeks. It is based, unless they choose to extend it, but we can't count on that. It is based on 3 facilities: the new, the priority, and the expanded. I want to give some context to the program. This is not an entitlement program like PPP. Not everyone can get it. You have to have done well and meet certain thresholds last year and debt requirements in order to get the loan. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank where you have a relationship. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Those banks are sorting through their credit policies and procedures and are not 100% ready yet. And the lists of lenders on the Federal Reserve website who are participating in the program is not 100% complete or accurate at this time. You should consider why would banks do this? Existing lenders would consider adding additional debt to give your companies more runway and protect their current liabilities. And new lenders are looking for strong credits and new banking relationships. And each bank has its sort of own agenda for this program. You will get this through your bank, savings association, or credit union. And at this time, we understand there are between 300 and 400 banks considering participating. To be eligible, your business must be established prior to March 13, 2020. And you may have to meet at least one of the following 2 conditions. You cannot be more than 15,000 employees or more than $5 billion of annual revenue. And your business has to be created or organized in the United States. To meet the U.S. eligibility test, you have to have the greater of 50% of your assets in the United States, net operating income generated in the United States, and annual net operating revenues generated in the United States. Subsidiaries of foreign companies can apply for the program, although they are not allowed to send the money upstream to their parent. To be eligible, you need to be a partnership, an LLC, a corporation, an association, a trust, a cooperative, a tribal business concern, or a joint venture with no more than 49% participation by foreign business entities. Sole proprietors are not allowed to apply. Nonprofits, the Federal Reserve is working on a program for them, but it has not come out yet. Ineligible borrowers include developers and landlords, and certain other industries such as private equity companies can apply, sex companies, gambling companies, etc. How do the affiliation rules work? An affiliated group of companies can only participate in one Main Street facility, and their loan cannot exceed the maximum loan amount for that facility. So let's dig into the new and priority facilities to start. They share some attributes. They are a secured or unsecured term loan. There's a 5-year maturity. Principal payments are deferred for 2 years, and interest payments are deferred for 1 year. Pay nothing in year 1, interest only in year 2 and 3, then 15% at the end of year 3, 15% at the end of year 4, and a balloon of 70% at the end of year 5. They are priced at an adjustable rate of LIBOR on the 1 or 3-month index plus 3%. Rates, you can estimate rates being approximately 3.31% at this time. Prepayment is permitted without penalty, and the origination fees are between 1% and 2%, and most likely will always be 2%. How does the new facility work? These loan sizes are between $250,000 and $35 million. How do you calculate what you might be eligible for? Well, let's take an example in row number 3, a company with $500,000 of 2019 EBITDA. To calculate it, you take 4 times their EBITDA of $2 million, you subtract their existing debt of $1.5 million, and that would give them a potential new money loan of $500,000. That same company in row 1 with $500,000 worth of existing debt would be able to get a potential new money loan of $1.5 million. In case of a bankruptcy, your new lender for a Main Street loan must have the same rights as all your existing lenders, which means you have to negotiate that with your existing lenders. In the normal course of business, the new lender's rights can be subordinate. These loans can be secured or unsecured depending on what you work out with the lender, and you are allowed to take on additional net debt after you get the loan. Now let's talk about the priority facilities, which are between $250,000 and $50 million. Let's take these all operate at 6 times your 2019 EBITDA. So just take the same company we discussed before with $500,000 of 2019 EBITDA. Their amount not to exceed would be 6 times that, or $3 million. If that company had $1.5 million worth of existing debt, they could get a potential priority money loan of $1.5 million. If that same company had $500,000 worth of existing debt in row 1, their potential priority money would be $2.5 million. What is unique about the priority facilities is that you can refinance debt into it as long as it is debt, not debt from the company that you're borrowing it from. And the lender's rights here have to be senior or on par with all other lenders, except for your mortgage lender, assuming your mortgage lender's rights are only against the property. And these loans can be secured or unsecured, depending upon what other debt you might have and what you can work out with the lender. Expanded facilities are bigger. They are between $10 million and $300 million. So, and these would always be done with your existing lender. If you take a company in row 3 with $10 million of 2019 EBITDA, the maximum expanded facility they could get would be $60 million. If that company had, I'm sorry, I wanted to use a company in row number 2. If that company had $50 million worth of existing debt, they could then get a potential expanded money loan of $10 million. These rights tag along with the rights of the existing lender and otherwise share all similarities except the origination fees are between 0.75 and 1.5%. The borrower certifications and covenants, you have to commit not to use these loans to repay old debt while you have the loan. And the only time you can refinance old debt into one of them is when you take the priority facility. And you commit not to cancel or reduce your existing lines of credit with this loan. And you certify that you have reasonable reasons to believe that you will not go bankrupt during the 3 months after getting the loan. While you have the loan, you can repay a line of credit, including a credit card. You can take on additional debt obligations as long as they don't interfere with the security rights of the Main Street lender, and you can refinance maturing debt. There are certain distribution restrictions. You commit to follow, and there are some exemptions for them for pass-through tax entities such as S corporations. While you have the loan and for up to 12 months after you have the loan, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. Those who earned between $425,000 and $3 million in 2019, you are not allowed to earn more than that for while you have the loan in 1 year thereafter. For those who earn more than $3 million, so you earned $6 million, what you do is you take the difference between 3 and 6, which is 1.5, you add that to the 3 and you get $4.5 million. You agree to make reasonable efforts to retain your employees during the life of the loan. Although unlike PPP, which primarily focuses on this is really a side issue in the Main Street lending program. Your lender will calculate your EBITDA. If it is a lender you've worked with previously, they will calculate your EBITDA or any proposed adjustments in the same way they have historically calculated EBITDA for you. If it is a new lender that you've not worked with previously, they will have to calculate your EBITDA in a way they have done so historically for companies like yours. Your debt will be calculated based on the date that you apply and will include any existing drawn and undrawn debt from any private or bank lenders. If you have an asset-based line secured by accounts receivable and inventory, then the amount that you actually have borrowed against it will be counted, not the amount that you could borrow. How do you pick between the new, the priority, or the expanded? Let's take in row 2 a company with $4 million worth of EBITDA and $10 million worth of existing debt. That company might be able to get a new facility of 6 or a priority or expanded facility of 14. What they work out will depend about what they can negotiate with their banks and the liens and how much money they need. Financing strategy, my friends, is like offense and defense. And I want to share with you 3 examples about how borrowers are planning on using these loans. One example is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee. They're planning on getting an MSLP for liquidity and for defensive purposes. They would rather not draw down their entire line. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They have planned to acquire companies at pennies in the dollar and use the MSLP money to help. How much cash will be required to get your business back up on stable footing? What is the best case and worst case scenario? Where will the cash come from and how will you get it? And as you look forward, what opportunities would you like to take advantage of with COVID-19? And does this give you an opportunity to capitalize them? Those are my prepared remarks. Thank you so much. And now I'm going to ask the moderator, Hannah, to take your questions.
Thank you, Ami. Hello, Ami. Is it true that the MSLP collateral requirement is borrow, owned, and occupied real estate?
It doesn't have to be, but it can be. So if that real estate has no liens on it presently and is owned by the company that is applying for the loan, the borrower certainly has the rights to take it. Although be careful be careful that landlords and developers are not entitled to get Main Street lender programs.
Will pending UCC filing stop you from being eligible for the loan?
They really shouldn't. The pending UCC filings only count when you've got them. But if they get filed while you're applying for the loan, then it's going to be an issue.
What's the rationale for being able to refinance debt from other lenders, but not debt from the banking provided the MSLP?
Um, They don't want this. I'm not 100% sure, but I think they don't want banks to use this as a tool to pay off their old debt and sell 95% of it to the Federal Reserve.
Will single member LLCs, which can be considered sole proprietorship, can they be eligible for MSLP?
I'm not 100% sure. The new guidance of this morning only references sole proprietorships, so I'm really not certain about that.
In your email earlier today, you spoke of PG. Can you review?
Sure, the banks can have, at their option, can demand a PG. And in all the files with about 30 banks around the country, we're working with in about 98% of the cases that are just absolutely emphatically demanding PG. What they are not allowed to do is they are not allowed to use the PG to, they're not to bifurcate the PG. They can't just PG their 5%. If they're going to demand the PG, it has to be in the entire loan amount, not just the 5%.
My bank has denied offering me the MSLP because I'm not in financial trouble, and they cited specific language on the Fed website. Are there other banks lending to companies even if not in financial trouble?
100%.
In the last seminar, you mentioned about waiting for guidance on the LLC managers making income other than just tax.
We haven't seen any additional guidance on that topic.
What are the stipulations on the S Corp dividends after taking MSLP money?
So Dustin, you can't take them. The question is, that's still not clear if you can take them. You can take them for tax liabilities, but you can't take them in excess of that. Now, it's unclear if you had them as part of your compensation over the last couple of years, if that serves as a baseline. We don't know that yet.
Does it make sense to apply with several banks and go with whoever gives the best deal? It seems that there's a lot of disparity between how much each bank will give and what the terms will be for each.
The terms from each bank have to be exactly the same. They have no latitude on the terms, except there's two things. They can decide if it's going to be a LIBOR 1 plus a LIBOR 3, and that's a difference about 0.13, and they can decide if the origination fees are going to be 1 or 2%. In all of our work, every bank is, the only variance you can get is on the amount of the loan that they'll qualify for, but nothing on the terms.
Are there banks that are taking MSLP clients that don't have current relationships with, and which ones?
There are, and some of them are mentioned on the Federal Reserve's website, and we also have our own proprietary list at MultiFunding that we're using for our clients.
Also, can you elaborate on the max EBITDA guidelines?
I'm sorry, Dustin, I don't understand your question. Happy to take any additional questions, folks.
You were saying profit can't exceed a certain amount. I think that's on the max EBITDA question.
Dustin, I'm still not trying to understand where your feedback is coming from. I'm happy to invite you to chat, to speak if you want to. Hold on one second. Just a second. Dustin, I just allowed you to talk if you want to try talk it through.
Yeah, can you hear me?
Sure. Hi, Dustin.
Hi. You were saying like after you take the MSLP, they want to limit your EBITDA the next year. So if you had like 450K EBITDA,
No.
you'd
It's
have
not. It's not EBITDA. It's your salary.
Oh, okay. So they're going to limit the actual.
What you can take or withdraw out of the company. That's the limitation.
Got it. So they're going to limit not only the potential like pass through the dividends or the draws, but they're going to limit the actual salary.
Yeah, so whatever your salary was last year, that's what you're limited on for why you have the loan and 1 year after.
I see.
And if your salary was less than 425, you can take it to 425, but then you're capped at 425.
Got it.
Anything
Thanks.
else?
No, I'm good. Thanks.
Happy to take any other questions.
How does this work with PPP and EIDL?
The PPP loan will, they both loans count against your the debt amount. Even though the PPP will be forgiven, it will still count because it won't be forgiven yet by the time you place this application. So you have to calculate your PPP amount into your total amount of debt. The EIDL, there's not clear yet if the government or the SBA is going to work on subordination agreements with Main Street lenders. So you can likely count on having to refinance your EIDL and use the priority facility.
And to clarify, does it make sense to apply with several banks?
John, we are doing that with our clients. We're putting each file in front of several banks, but prepare for it's a long and arduous process because banks are just getting their heads around how to do these and what to do with them.
What debt to equity ratio or cash flow coverage ratio would enable avoidance of the PG, or i.e. additional equity in properties?
Todd, that's really a bank dependent question. There's not a Federal Reserve policy on that. Each bank would look at that separately.
If I have a parent company and several subsidies, must I combine, or can one subsidy apply for the loan?
One subsidy, it really depends how the tax returns are done, and if each subsidy files their own tax. If they each file separate tax returns, one subsidy can apply for the loan, but then the maximum loan size goes across subsidiaries.
How does the lender determine your 2019 EBITDA for loan amounts? Company prepared financials, tax returns?
Tax returns. Or audited financials, one or the other.
Can you elaborate on how loan amounts may be limited based upon operating expenses being lower than COGS out of the total expense?
Really, John, the loan amounts will be driven by EBITDA calculation, and so I'm not sure how your question is really applicable. They're going to dig in and look at the EBITDA of each company. Where there might be some movement will be on what adjustments to EBITDA some banks may allow versus others.
Our bank is asking for 2018 taxes. Is that relevant? They only need 2019 financials so far, but asking if we did 2019 as well.
Highly relevant. What other questions? Questions once, questions twice. Happy to take any questions. I just gave my permission to my friend Scott Reeves to talk. Hello, Scott.
What do you want?
Hello, everybody. Scott and I love each other, so we like to tease each other. So I decided to put him on a spot. If anyone's looking to join a Vistage group in Northern California, Scott's your man. How's that, Scott?
I got my members on there.
Ah, there we go. We're making them feel special, making you feel special in front of them. All right, everybody.
So, Ami,
Yeah.
talk more about the personal guarantee, because that's curious to me, why they're asking for 100% of the loan now. Is that the Fed guides, or is that what banks are doing?
Banks can ask for the federal personal guarantee at their discretion. It's entirely up to them.
Yeah, because a lot of my members have the sizable MSLP amounts that are available, but I'm not sure they have that personal guarantee to go.
You don't
along with
have
it.
to, you don't have to have the full amount to guarantee it, but you are technically on the hook for it personally if you default on it. So they're not looking for 100% collateral, like liens on your houses or things like that, but they are in many cases asking the business owner to guarantee it. And if they guarantee it, the next fair question many people have asked is, well, can't we just take a guarantee on the 5% instead of on the whole amount? And yesterday in the guidance, the Federal Reserve came back and made that clear that that was not allowed. If you're going to take the guarantee or ask for collateral for the business, it has to be in all of it, not just the 5%.
Okay, so I get $3 million. That's what I qualify for. Bank needs a personal guarantee for the $3 million. I don't need to have that in totality. I just
No.
need to be personally saying I'm going to be good.
You're willing, you know, you could pay it over 20 years, but you're in some agreement, but you're on the hook to pay them back for it.
Good. That's an important qualification.
I think we have something else in the Q&A.
Yes, clarifying question. If you are making less than 425K, let's say 300, can you give yourself a raise to 425 when you have the money, or no raise period?
No, Dustin Allen, it's not clear in the guidance, but I think it's reasonably safe to say that you can max yourself up to 425.
Do they need audited financials or just company prepared unaudited?
They're likely going to need audited, or or reviewed or consolidated or tax returns done. Something other than company prepared. Now, Scott Reeves is having Ami envy. He wants a copy of my Zoom background.
You talk too much.
Anybody else? All right, everybody. I hope this has been informative. I need to head out to another obligation. Wish you all Godspeed. And if you have any other questions, feel free to reach out. Take care now.
Thank you, Ami.
Bye, Scott.
Bye, Ami.